Earnings relative to last year, not great. Earnings relative to expectations, pretty decent. What is the more relevant benchmark for you and the team?
The absolute level of earnings, which will be $53 and maybe 75 cents for the second quarter of this year, which will be down 3 or 4% from last year. Perhaps more importantly, earnings are flat against 2 years ago. And we've had a lot of inflation over the past 2 years. So the real earnings growth is quite negative. I won't even get into it, but earnings quality is concerning as well. But for those who are talking about beating expectations, most of the expectations were beaten only because the estimates were cut at the last days before reporting. Long story short, earnings are going to be flattish, probably well into next year. And that's even assuming that we don't slip into a recession. This is a difficult environment for profits. It was a great environment for profits in late 2020, early 2021. And this is just going to be a long digestion before we see healthy earnings growth again out of the S&P.
David, I hate to pick on one single name. I'm certainly not an Apple analyst, but it is the biggest weighting on the S&P 500.
That's right.
And I think it serves as an example for the broader story that you and I can discuss. There's a name that is posting negative growth, is still up double digits year to date, and it's the biggest weighting on the S&P. David, what's the takeaway from a story like that one, without getting into new iPhone launches, etc.? But we're talking about multiple quarters of negative growth, trading at a 30 multiple, 30 times earnings. What's that about?
Jonathan, you make a really good point. I mean, Apple is the biggest company in the index, but it is probably representative of what's the thinking is and what I'm concerned about in the equity market. Earnings growth is flattish. Sure, there will be a return to healthy earnings growth probably next year. But in the meantime, look at the valuations with a name like the one you said being at about 30 times this year's earnings, and the broader S&P 500 being about 21 times earnings. But even if you exclude tech, energy, and financials, the S&P is still a little bit more than 20 times earnings this year. So I want to ask the question, if you're bullish now, why weren't you outrageously bullish over the past 10, 12 years? There's either something wrong with valuations and investor sentiment right now, or there's something very wrong with it over the past 10 years. Look, I think people were too bearish for a very, very long time, and they're trying to make up for that by being bullish now. But now's just not the right time for that. And it's not a Goldilocks economy. I would argue it's kind of a long trek through a dark woods for a lot of corporate America, and especially smaller companies, because the profitability growth is going to be hard to come to for another few quarters. So, look, I think it's been a giddy summer for the equity market, and it'll be back to reality in the autumn and into year end. This is why I think we're going to have a correction. I think tech deserves to be part of that correction. But my biggest concern at tech is really hardware and semiconductors, less so software. But yeah, the hardware, including the name you mentioned, and the chips war. The global chips war is real. There'll be a lot of CapEx spending there. I'm not sure this is going to work out also wonderfully for shareholders.